If you had $500,000 sitting in your portfolio right now, would you know exactly how to invest it? And more importantly, would it pay you every single month? Because one ETF, SCHD, could generate over $18,000 a year in passive income. It's not hype, it's not speculative. It's dividend investing done right. In today's video, we're breaking down how SCHD fits into a $500,000 portfolio. We'll cover how much income it really produces, how to build around it, and the exact role it can play in a smart retirement strategy. Whether you're aiming for financial freedom or already managing a sizable portfolio, this breakdown is for you. And by the end, you'll know exactly why thousands of investors are leaning on SCHD, even in uncertain markets. Let's dive in. What is SCHD? SCHD stands for the Schwab U.S. Dividend Equity ETF. It's designed to track the performance of high dividend-yielding U.S. stocks, with a solid record of consistent dividend payments. The ETF holds around 100 companies, all screened for quality, sustainability, and yield. That means strong fundamentals, reliable cash flow, and a history of rewarding shareholders. Some of its top holdings include names like PepsiCo, Cisco, Home Depot, and Merck. These aren't just popular stocks, they're dividend machines. Why is SCHD popular with income investors? Simple, SCHD delivers passive income and peace of mind. You're not relying on hype stocks or market timing. You're building a stream of income from established profitable businesses. Over the past decade, SCHD has averaged an annual return of roughly 11%. That's impressive for a dividend ETF. But more importantly, it consistently yields between 3 and 4%, often higher depending on your entry point. For a $500,000 portfolio, that's potentially $15,000 to $20,000 a year in dividend income alone. And those dividends can be reinvested or used to cover your expenses. The power of dividend growth. Here's where SCHD really stands out. It doesn't just pay dividends, it grows them. Over the last 10 years, SCHD has increased its dividend payout by an average of 10% annually. That means your income stream fights inflation and gets stronger over time. For investors looking to maintain their purchasing power through retirement, that's a powerful edge. How does SCHD compare to other dividend ETFs? Let's look at a few alternatives. BYM, Vanguard High Dividend Yield. BVY, iShares Select Dividend. NOBL, S&P 500 Dividend Aristocrats. While each of these ETFs has strengths, SCHD often wins on a few key metrics. Higher 10-year total return. Stronger dividend growth. It's a rules-based selection process. Low turnover and minimal hidden costs. SCHD's screening process targets sustainable, high-quality companies, not just the highest-yielding ones. That reduces risk and keeps the dividend stream more reliable. How I'd use SCHD in a $500,000 portfolio. If you had $500,000 to invest today, you probably don't want to put it all in one fund, even one as strong as SCHD. Instead, SCHD might make up 30–50% of your equity allocation. Here's a sample long-term income-focused portfolio built around SCHD. 40% SCHD, 30% VTI or VOO, broad US market, 20% VX-US or SCHF, international, 10% bond ETFs, T-bills, or cash. This structure provides reliable income, long-term growth, and global diversification, all with a passive set-it-and-forget-it approach. Tax considerations. SCHD is relatively tax-efficient for a dividend ETF. Its low turnover means fewer capital gains distributions. And since it's composed of U.S. companies, there's no foreign dividend withholding tax. But keep in mind, dividends are taxed as income. So if you're in a high tax bracket, you may want to hold SCHD in a tax-advantaged account like a Roth IRA. What happens in a down market? SCHD isn't immune to volatility, it holds equities. But because it focuses on high-quality cash-rich companies, it tends to be more defensive during downturns. During major drawdowns like 2020 and 2022, SCHD held up better than many growth ETFs. And even when the price fell, the dividends kept coming. That's the value of owning businesses with consistent earnings and healthy balance sheets. Risks to consider. Every investment has risk. SCHD is heavily weighted toward industrials, financials, and consumer staples, meaning it's underexposed to tech. That might limit your upside during tech-driven bull markets. Also, dividend investing can sometimes sacrifice growth. If you're younger and focused purely on capital appreciation, SCHD might not be your best core holding. But for income-focused a portfolio, it's hard to beat. Dividend reinvestment strategy. One way to maximize SCHD's value is through DRIP, a dividend reinvestment plan. Rather than cashing out dividends, you automatically reinvest them to buy more shares. Over time, this creates a compounding snowball effect. More shares equals more dividends equals more shares again. It's a powerful way to grow your income stream even faster, especially if you're not touching the income yet. Who is SCHD best for? HCD can work well for retirees looking for consistent income, younger investors building a passive income stream, anyone looking for an ETF with a long-term, quality dividend focus. It's also a great anchor ETF, something to build around with broader market exposure. Final thoughts. A $500,000 portfolio can be life-changing, but only if it's structured properly. And for many investors, SCHD offers the income, quality, and simplicity they're looking for. It's not the flashiest ETF, but it quietly delivers on what matters most: steady growing income from real companies. If you found this breakdown helpful, subscribe to Asset Index for more weekly videos on ETF strategies, dividend investing, and building long-term wealth, one step at a time. See you in the next one.